Hi, I'm Tom Lydon here in Hollywood, Florida at the Inside ETF conference. I'm now here with John Love, President and CEO of USCF. Great seeing you, John.
Good to see you, Tom.
So let's talk commodities. I mean, sure. For the last 10 years, we've been talking stocks and bonds, but with all this volatility, more advisors are talking about commodities. What's going on?
Well, it's been an interesting market the last couple of years. We actually had a nice rally between 2016 and the first half of last year. This time last year, people had seen that for a while and they were starting to get excited about commodities. So I think a lot of people didn't even realize that commodities were starting to rally upwards. But we got to the top of 2018 and obviously we had some impacts from the trade wars, tariffs, all the international rhetoric, and then we had the situation with crude oil where it had recovered nicely after 2014. OPEC was worried about an undersupplied market because of Iran sanctions. They boosted up production to keep prices under control, and they ended up accidentally oversupplying the market because of the sanction waivers that we gave out to 8 countries. So it took a toll, but I think commodities are in a healthy place. The U.S. economy is still good. You've got some slowing in China, but slowing growth is still growth. So I think it's a good time.
So in commodities, to understand, there are a lot of variety of commodities, and not all commodities correlate in the way they perform, right?
That's absolutely right. Risk, if you look at equities or bonds, look at different indices, like, compare the Dow to the S&P 500 or even an equal weight S&P 500, they tend to cluster together in risk return space. Same thing with bonds. Commodity indices are all over the place. So methodology matters very much with commodities.
Okay. Run through your suite really quickly, because some are specific to certain commodities and some are kind of a basket.
Sure. We have our most well-known funds, USO, UNG. I think anybody interested in commodity investing.
Oil and natural gas.
Oil and natural gas, they've heard of those. You use those tactically if you have a view on crude, natural gas, that kind of thing. We've got a copper fund, gasoline, Brent oil, those kind of things. So we've got some variations on crude, even some a triple up crude fund, a triple down fund, but we have broad commodity funds for people that are looking for a permanent allocation to commodities, which we think we should own to diversify your portfolio. You can look at USCI or SDCI. They hold 14 commodities at a time, equal weighted, and we look for a measure of low inventory to basically take advantage of the supply-demand dynamic in commodities, and that's never going to change.
Final point here. Talk to me about the performance of the S&P 500 compared to commodities. We haven't seen a spread like this in a long time.
We haven't. If you look actually from 1998 to 2008, you see the opposite of what we have right now. Obviously the financial crisis occurred, but commodities were the winner in the previous 10 years. This last 10 years, obviously we've had a rocketing equity market, and as you said, commodity returns have been extremely tepid. They've been, in the lower percentile relative to where they've been over time. So
advisors know everything reverts to the mean every once in a while.
Yes.
and that's something to consider. So I know a lot of advisors are talking about it. So I know you've been busy talking to advisors here.
Indeed.
Excellent, John. Great seeing you.
Tom, great
Thank
to see
you.
you.
Thanks
very much.